The new Federal Reserve Chairman just stood in front of the world, and he said inflation is the Fed's only focus right now. Rate hikes are likely coming. That was Kevin Warsh's message at his very first press conference. Markets sold off immediately after, and then bounced back the next day on falling oil prices. That whiplash is not random noise, it is telling you something important. Here is the uncomfortable part most financial commentary is skipping over. The real story this week is not just about inflation numbers. It is about what happens when the most powerful financial institution in the world changes hands, and what that change actually costs people like you. Let me explain exactly what went on this week. Kevin Warsh was confirmed as Fed chairman on May 13th. He was appointed by President Trump after Jerome Powell's tenure ended in May. His first press conference happened just days ago, on June 17th, and his message was clear and deliberate. Inflation is above target. Rate hikes are on the table. The Fed is not done tightening. Now on the surface that sounds like responsible central banking, and maybe it is. But here is where it gets more complicated. The Fed's own dot plot, which tracks where policymakers expect rates to go, is deeply divided right now. Half of Fed officials project at least one rate hike. The other half expect no change, or even a cut. That is not confidence. That is an institution that does not agree with itself. And markets responded by pricing in a higher Fed funds rate than the Fed itself projected. Let that settle for a moment. Investors are now betting the Fed will be more aggressive than Fed officials expect. That gap matters enormously for your money. Now here is what most people are not connecting. When the Fed raises rates, it does not feel abstract. It shows up in your mortgage payment. It shows up in your car loan refinancing. It shows up in your credit card interest rate. It shows up in small business loan costs. Rate hikes are not a Wall Street story. They are a kitchen table story. And right now, the people with the most debt are the most exposed. Think about who that actually is. Young families buying their first homes, recent graduates carrying student loans, middle-income households using credit to manage rising grocery bills, entrepreneurs who borrowed to grow their businesses during lower-rate years. These are not wealthy investors with diversified portfolios. These are everyday people who made completely reasonable financial decisions, and they are now sitting in the crossfire of a rate debate. Here is something worth pausing on. The Fed's preferred inflation gauge is called the PCE price index. Headline PCE has been rising in recent months. Core PCE, which strips out food and energy, has also moved higher. Both are now above the Fed's 2% target. That is the data Warsh pointed to, and that data is real. But here's the part that creates a genuine contradiction this week. Oil prices just dropped 9.5% in a single week. WTI crude is now trading near $75 a barrel. That is the lowest level since early March. Energy prices are one of the biggest drivers of headline inflation. When energy falls this sharply, this quickly, the inflation picture changes. The data Warsh responded to may already be stale. The numbers he cited were collected before this oil crash happened. So we have a new Fed chairman signaling rate hikes based on backward-looking data. And simultaneously, one of the biggest inflation inputs is collapsing in real time. That tension is significant, and it is something everyday investors should understand before they react emotionally to rate hike headlines. Now, why did oil fall so fast? The US and Iran signed a memorandum of understanding this week. It begins a 60-day negotiation period. Vice President Vance confirmed that more than 12.5 million barrels of oil passed through the Strait of Hormuz just last night. The market immediately priced in reduced supply pressure. That is why oil crashed 9.5% in days. But here's the nuance. Israel has continued strikes on Lebanon. Questions remain about Iran's nuclear program. The 60-day window is just that, a window. It is not a deal. It is not a resolution. It is a temporary pause in hostility, which means this oil price drop could partially reverse. And if it does, the inflation picture changes again, and the Fed debate about rate hikes shifts again. This is the volatility loop everyday investors are living inside right now. If you are finding this useful, consider subscribing for more practical financial insights. So what does a grounded investor actually do with all of this? First, stop treating Fed headlines as binary. Warsh did not guarantee rate hikes. He said they are possible. Half of the Fed does not even agree with that direction. Markets pricing in a more aggressive path than the Fed itself suggests overshooting. Second, understand the oil wildcard. The incoming PCE data will be watched more closely than usual. But even before that data arrives, oil's move this week is doing real work. Falling energy prices cool inflation at the pump and in shipping costs. That has downstream effects on consumer goods prices within weeks. Third, think about what happens to short-term bonds right now. Edward Jones flagged this directly this week. Short-term bond yields have risen from recent lows. The yield advantage over cash has widened meaningfully. For everyday investors sitting in savings accounts earning almost nothing, that is a real shift. You do not need to be wealthy to act on that. A 1 to 2 year treasury or short-term bond fund now offers a genuinely competitive yield. That was not true 2 years ago. Fourth, and this is the part worth sitting with, Warsh's credibility as a new chairman depends on being seen as tough on inflation. Every new central bank leader faces this test. If inflation remains above target and he does not act, the market loses faith in him. But if he hikes aggressively into an economy already slowing, he risks triggering a recession he does not want. That is the tightrope every Fed chair walks. What makes Warsh's position unique is the political backdrop. He was appointed by a president who has historically pushed for lower rates. The question being whispered in financial circles is simple. Can Warsh be both independent and politically acceptable at the same time? History suggests that is one of the hardest balancing acts in global finance. And when that balance gets questioned, bond markets react, equity markets react, currencies react. Every asset class prices in that uncertainty. That is not conspiracy thinking. That is how markets have always worked. Real institutional investors are watching Warsh's every word right now, not because of what he says, because of what his decisions signal about who the Fed is actually working for. And right now, that question does not have a clean answer. Next week brings the monthly PCE report. It will either confirm the inflation picture Warsh described or complicate it significantly. Micron Technology earnings also arrive next Wednesday. Fresh all-time highs this week with markets watching closely. The coming days will be some of the most data-rich of the summer. And the Fed chair who just delivered a rate hike warning will be watching every number just as closely as you are. The people who understand what is actually happening right now will be positioned better for whatever comes next. That is what the data is showing. What you do with that information is entirely up to you.